Everyone, welcome back to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Huge show today, a lot to talk about. Today's show is brought to you by my friends at YCharts. YCharts is an awesome data analytics and charting platform. Take a look at the show notes for a link to a free trial to YCharts and 20% off when you first sign up for the service. So let's start out talking about inflation. So we have this new Inflation Reduction Act that's been passed. And what is it trying to address? Well, the highest inflation that we've seen in the US in over 40 years. So the July report started moving in the other direction. This is the first time, if you bet the under in terms of the expectations, you would have been correct. So heading into the report, the expectation was for an 8.7% year over year increase, but instead the number came in at 8.5%. Now, why did the inflation rate decline? It was 9.1% in June. The big factor really driving that decline was the decline in energy prices. As we've been talking about, crude oil and other commodities are starting to move in the other direction. And those factors really led to the decline in the rate of inflation from 9.1% to 8.5%. So here's a look at the breakdown in terms of the major components. As we talked about, still a big year over year increase in terms of fuel oil and gasoline, just lower than they were back in June. And if we look at other major components, not everything was moving down. We had things like shelter tick up again. So that's an important factor, as we talked about, because it's 33% of the index. It's what people spend the most money on. And as we talked about, this is really being underreported. So it's kind of playing catch up here with shelter supporting that higher inflation rate, I think, for months to come. We also had things like food at home ticking higher again, very important factor. Hopefully that moves back in the opposite direction, and electricity moving higher as well. A lot of that is from the rise in natural gas, which continues to hit new highs, highest levels we've seen since 2008. Most of the electricity in the US is generated from natural gas. And so overall, we'll take a win where we can get it. Happy to see the inflation rate come down. Hopefully, it continues to come down. But at 8.5%, still, of course, a big problem, still very, very high. So they passed this new Inflation Reduction Act. There was a lot of stuff in there. I don't want to get into the details, but the big question is in the name, the Inflation Reduction Act, and will it actually serve to reduce inflation? I polled Twitter asking this question. Most people seem pretty skeptical, with only 12% saying it's going to reduce inflation, around 30% saying no net impact, and 58% saying it will increase inflation. So it's hard, of course, to project and try to predict these type of things, but we have two independent sources. One from Penn Wharton, so the university, who does a study on all of the major bills, and the Congressional Budget Office as well, puts out a report in terms of how it will affect the deficit and inflation. And both of these sources came to the conclusion that the impact from inflation is indistinguishable from zero. And so there could end up being a positive or negative effect. It's probably going to be impossible to parse out. The inflation rate, of course, is going to move in the next few years, and you will have to say one way or another that it was due to this bill or not. But just looking at the factors and what's in this bill, it doesn't seem to be things that are going to have a positive immediate net impact on inflation. And in terms of the deficit, that's a much harder thing to predict. They're saying initially it's going to increase the deficit in terms of the spending and outlays, and they're expecting the deficit to maybe go down a little bit in the later years because of an increase in tax revenue. So they're putting in this minimum corporate tax of 15%. And the other thing that they're counting on is a little bit controversial. There's some pushback, but they ended up getting it in there, is this $80 billion allocation to the IRS to hire more agents for enforcement. improve their support and I guess systems. But just a huge increase in terms of the percentage increase in terms of the budget for the IRS. And the assumption is this is going to lead in a few years to more tax revenues. And so I think the pushback would be instead of trying to hire all of these people and put all of these things in place to try to bring in more revenue, why not instead focus on simplifying the incredibly complex tax code? And I think simplification would make enforcement much easier. The tax code could be written in a way that it's almost automatic when you file your taxes instead of spending days and weeks figuring out what you owe. Simplification of the system without the loopholes, without all of these crazy deductions, I think would be a better way. But every time we seem to have a piece of legislation, it seems to go in the opposite direction, where it's only really benefiting accountants and lawyers who seem to bill higher and higher fees to help people figure out what they owe for their taxes. So a little bit disheartening. Hopefully, at some point in the future, we'll move towards a more simpler system. And instead of putting more money into the government to try to collect taxes, we'll put efforts into simplifying the system. Without you can do it in a way where there's really no impact on the revenue. You're just eliminating all of these loopholes and deductions and coming up with a flat tax in terms of percentage, and then you exclude a certain amount in terms of income, like a standard deduction, and then a flat tax, and then everything else you kind of eliminate. I think that would be a better system. But in terms of the word, again, Inflation Reduction Act, I think it'll prove to be a misnomer. Just like the Affordable Care Act didn't make healthcare more affordable. You actually saw the cost of healthcare rise significantly for anybody that was paying for healthcare. This is going to go down in history as another one of those bills where really it's not addressing what it was supposed to address. And then, ironically, the cause for most of the inflation that we've had thus far is twofold, as we talked about. It was government spending, so borrowing and government spending, creating too much demand, so too much money chasing too few goods. And you also had the Federal Reserve buying that debt and keeping interest rates ultra low, and an increase in the money supply, 40% increase. So all of those factors were the primary drivers of inflation, in addition to the supply issues. But this bill doesn't seem to address any of those things. So ironically, just doing nothing and not looking to spend more money and would actually help inflation more than anything else. So just the government getting out of the way, and if they're going to do anything, would be lower regulation, try to increase production in terms of incentivizing companies and incentivizing more production of oil and natural gas. That would do more than I think anything else to reduce the rate of inflation, but wasn't in this bill. Perhaps we'll see that at some point in the future, but I'm guessing this will be the last major bill that is passed, because in November, you're likely to see a change in terms of the power structure, where the Republican Party is likely to take back the House and possibly the Senate as well. It'll be very difficult for the Biden administration to pass anything else after that point in time. So moving on to the Fed, let's talk about how the latest inflation report is going to affect the Fed and why they really can't stop tightening at this point. Moving down 1 month is just not enough for the Fed to say, let's pause here or let's slow down, because there's still this enormous gap between the inflation rate in the US at 8.5% and where the Fed is at 2.25 to 2.5%. So still a very low Fed funds rate, given where CPI is. And just to illustrate how different the Fed is today than the last time inflation was a threat in the US, back in the 1970s and early 1980s, you had a Fed funds rate much higher than today, and oftentimes above the rate of inflation before the back of inflation was broken. So here we are with the Fed still having a highly negative real Fed funds rate, subtracting inflation. And back then, you had the Fed moving to a positive Fed funds rate, with driving that Fed funds rate above the rate of inflation. So hopefully, they don't have to go as far as they did back then. We don't have to see double-digit interest rates to bring it down. But certainly, it would be hard to argue that the Fed right now is not still very much behind the curve, and that they'll have to continue to increasing rates in order to bring about the imbalance that they need. And so, the most important chart, I think, in markets and the economy is this one right here, looking at the real average hourly earnings. And so, in layman's terms, this is basically just taking wage growth and subtracting the inflation rate and saying what's left over in terms of, are your wages keeping pace with inflation? And so now we have 16 consecutive months where wages haven't been keeping pace with inflation. And as we talked about, that's an untenable situation for the American worker. It's a direct decline in prosperity. That's loss in purchasing power is a huge issue. That's the primary reason why the Fed needs to continue to normalize monetary policy to get inflation under control. And so it's not just the individual, it's businesses as well. Of course, this is having an impact on small businesses more so than other businesses, because they have a harder time passing on those costs. And if you look at the single most important problem for small businesses, they reported the highest percentage in terms of inflation being the single biggest problem since 1979. So this is front and center still. Doesn't matter if inflation's 8.5 or 9% or 7%, it's still way too high, and we want to see it move lower. So, what is the Fed going to do? They're likely to hike again in September, then again in November, and the market's expecting a smaller hike in December. And the median expectations in terms of Fed funds future is around 3.5 to 3.75% at year end. And so, that's been pretty consistent the past few months. Sometimes it goes a little higher, sometimes a little lower, depending on different data points. But the message is clear: the Fed is not done yet. You're going to see them hike again in September, and likely again thereafter, until it's clear that inflation, and not just inflation, but inflation expectations, are starting to move lower. So the Fed is not alone. I think this is an important point in terms of being behind the curve. If you look around the world at other major developed central banks, you're seeing a similar situation. And it's all, in my view, based on this belief, this naive belief, that in the developed world, inflation was something we didn't have to worry about. And so, if you don't have to worry about inflation, you can be easier in terms of your policy, and you could be slower to move. And I think that's been the case, not just in the US, but if we look at the Eurozone and we look at the UK and many other countries around the world, in the developed world, they're saying this was an emerging markets problem. We're not going to have a real problem with inflation. It's going to be transitory. And in all of these cases, it's proven that it hasn't been transitory. So if we're looking at the Eurozone now, 8.9% inflation. It's the highest we've seen on record, with data going back in time. And now, for the first time since 2014, the ECB has moved their interest rate back to zero. So their discount rate back to zero. And that's an important shift. And they had this negative interest rate policy instituted in 2014 on the belief that it would spur quote, lending and spending. Yeah, that was the exact words they used. And again, the belief was, if zero interest rates are good, then negative interest rates should be better. And what it caused, of course, is many distortions in financial markets. Instead of spurring lending, what it did is harm the banking system in Europe. And I think this is a good chart that kind of illustrates that. It's a chart of the European financials ETF during the tenure of negative interest rates. And as you can see, during this period of time, over 8-year period, the return on these European financial stocks was actually negative during this period of negative interest rates. So just an incredible thing to see. And if we contrast that with the U.S. financial stocks, they had more than double during this time. And it's not that the U.S. had very high interest rates; they certainly didn't have that. In many cases, they had 0% rates for the beginning here, and then again in 2020, but they weren't negative. And so the notion that if zero interest rates are good, that negative interest rates must be better, I think is definitely proven to be false. And I think the greatest trick that the ECB really pulled on the people of Europe is convincing them that negative interest rates were a good thing. And I think absolutely negative interest rates is just a distortion of the system that is not indicative of anything good. Lastly, let's talk about the Bank of England here. We have the inflation rate in the UK crossing above 10% for the first time on record there. So extremely high rate of inflation, even above the reported rate in the US. And what is the Bank of England's rate? 1.75%. So even lower than the US Federal Reserve. So what you have in common in all of these developed economies is they're still very much behind the curve. So we're going to see continued normalization at least throughout the end of the year, and they're going to try to close this gap, and it's going to come from a combination of inflation peaking and coming down, and hopefully that's the case in the U.S. that we're already starting to move lower. But the interest rate has to continue to normalize, I think, to make sure that it stays down. So let's shift gears here and talk about the big four companies in the US and some interesting stats that I put together. The big four being Apple, Microsoft, Google, and Amazon, the four largest companies in the US. And just some stunning statistics. First, let's talk about Apple. Apple's weight in the S&P 500 now is at 7.3%. That's the highest for any individual company in the index with data going back to 1980. So over time, you have different leadership. Back in the 1980s, you had IBM being the biggest company in the S&P 500 with a weighting of 6.4%. During the dot-com bubble, Microsoft became the largest weighting in the S&P 500 at 4.9%. During the energy boom that happened in the 2000s, ExxonMobil became the largest weighting at 5%. And today, Apple dwarfs them all with a weighting of 7.3%. So very interesting to see that even in a bear market, Apple has held up incredibly well this year, much better than most technology stocks and better than the index as a whole. And as a result, its weighting in the index has moved higher. Another crazy stat from Apple in terms of buying back shares, stunning 522 billion in total buybacks over the last 10 years, and that's actually higher than the market cap of 494 companies in the S&P 500. So as you can see, just an enormous growth in buybacks of shares, and you can see the shares outstanding for Apple just continuing to move lower and lower. So just the numbers from Apple, of course, in terms of sales and profits and revenues, really dwarf almost anything else in the markets and the economy. And so these numbers are just incredible to see. And if we take Apple and we combine it with Microsoft, this is a stat that really blew my mind. You have a 4.94 trillion combined market cap for just these two companies. That's 1.75 trillion higher than all of the 2000 companies in the Russell 2000 combined. So just incredible amount of market cap that's in just two companies. So higher than all of these companies in that Russell 2000 small cap index. So unbelievable to see that. And this is this stat kind of goes hand in hand with what we're seeing in terms of big picture trends with small caps underperforming large caps. So you're seeing that go on now for over a decade, just of large cap domination over small cap companies. And as a result, you're seeing a higher market cap for these huge huge companies like Apple and Microsoft in relation to small cap companies. And so one could make the case that smaller cap companies are unloved and cheaper as a result of this, because if you compare, let's say, price to sales ratios for Russell 2000 versus Apple and Microsoft, there's getting to be a huge differential there. That's what I think a value investor would say, that perhaps there's some opportunity in these smaller companies, given that divide, and given the fact that Apple and Microsoft and these large cap companies are so loved. But it's hard to do that because they're loved for a reason. Their sales and earnings growth over the past 10 years have just been enormous, and we'll talk about that in a little bit. But first, let's switch gears here to Amazon and AWS. So the cloud business at Amazon is just stunning growth over the last 10 years, and now at 62 billion in 2021. I just pulled the data on this. It's higher than 448 companies in the S&P 500. So forget the other business parts of Amazon, forget the whole retail operation, and just look at their AWS cloud business, and that's at 62 billion, which is just a stunning number, and it's still growing this year. So while the rest of Amazon's growth has really slowed to a standstill this year, AWS is still growing at a really rapid pace. So if we look at the big four and we break down their revenues over the last 12 months, 1.35 trillion combined, and just to compare that to the GDP of countries around the world, that's higher than the GDP of all but 14 countries around the world. So many of these companies are now bigger than entire economies and in countries around the world. Just an amazing stat. So let's talk now about the housing market. There's a lot of data that's come out in the past few weeks, and it's kind of confirming the trend that we've been talking about now for months, which is that slowdown in the housing market is starting to now finally translate into price decline. So what we're seeing is the transition from a bidding war market where you were seeing multiple offers for every house that was for sale as early as this year. It hit kind of a peak, and now you're at less than 50% of homes that are for sale getting more than one offer, which is how they're defining a bidding war, and that's the fewest we've seen since early 2020. So as a result, demand is down. What are sellers doing? They're cutting prices, and so this is a chart showing you data going back to 2015 from Redfin, showing you the 4-week average of homes for sale that have cut their prices. And now we're up to 7.8%, and that's the highest we've seen. And they only have data going back to 2015, but the message is clear that sellers are having to reduce prices to stimulate demand, to get buyers to bid on these houses. And so as a result of this, it started out with just reducing prices from an elevated level, but now it's finally translated into outright price decline. So if we look at the trajectory of home prices, the median sales price of a home this year peaked actually here in June, and since then has been moving lower. It's now down over 5% since then. And so, to be sure, still well above where we were a year ago, but the rate of change is slowing pretty rapidly here. And so the housing downturn is here, and there's any number of ways to look at it. They're all important, so let's go through them one by one. We talk about home builders, very important, home builder confidence. And so after the pandemic stimulus efforts, home builder confidence went through the roof. They could not build enough houses to meet demand. There's just more demand than they had ever reported in history. And now today that's slipped below this index below 50, which means that more builders view conditions as poor than as good. And that's the first time we've seen that since 2020. And as a result of builders reducing their confidence, they're starting to build less homes. And so we're seeing housing starts now at a 17-month low, down 8% year over year. And importantly, you'll see these gray bars here, that these are recessionary periods, and housing starts tends to be a leading indicator. So it tends to turn down in advance of recessions. And so if we look at recessions in the past, you see housing starts move lower in advance of that. And perhaps again, that's what we're seeing today. Uh, Existing home sales are absolutely collapsing. So, as we've talked about a few times in the past few months, what you initially see before you see outright price declines is you see transactions just collapse. And why do you see that? Well, we're going to show you a chart in a little bit on affordability, but simply buyers go on strike, and sellers initially they're anchoring to recent prices, and they don't want to cut those prices. They feel like they should get something above the recent price. They certainly don't want to cut them, and so the result is there's a mismatch, and they're, sellers and buyers are not coming to an agreed upon price, and as a result, a transaction goes down. But as time goes on and inventory starts to slowly build up, sellers will eventually start to slowly cut those prices to try to stimulate some demand. But this stage is really in full force. It's the lowest existing home sales numbers we've seen since June 2020. And we talked about this last month, how this was likely to spread to all price ranges. So initially, we saw lower end home transactions go down, and higher end was holding up. And now we're seeing it across the board. So a pretty much broad base reduction in transactions. And it's not just existing home sales, it's new home sales as well. Now, if we look at the number of new home sales, it's actually 50% lower than where it was in August 2020, which was the peak in new home sales. And we're at the lowest levels in over 6 years for new home sales. So a stunning really collapse in a very short period of time. And what's driving this? Well, it's affordability, affordability, affordability. Can't stress this enough how important it is. So you have the mortgage rate more than doubling since early 2021, and you have home prices up significantly during that period of time. That's made the housing market less affordable than any time in the US since 1989, according to this one index. So huge factor there. And of course, what we saw back in 2006, following this similarly low affordability levels, is prices came down, and that's how this issue was resolved. So you either have to see mortgage rates come back down, or prices come back down to make housing more affordable and for demand to go up. And let's talk about the story in terms of retail sales. And there's two stories you can tell depending on how you want to paint the picture. If you want to paint the picture in a positive light, you would tell just the story of the top portion of this chart, which is showing you retail sales in nominal terms. So just the absolute dollar amount of sales. And that continued to hit a new high in July, and it appears to be still growing at a pretty rapid clip, up over 3% in the last 6 months. The problem, of course, is that we have inflation at a much higher rate than that. And therefore, if we adjust for inflation, we're actually seeing a peak in retail sales back in April 2021, and retail sales over the past 6 months are actually down if you adjust for inflation. So not down huge, but a very different story if you adjust for inflation. And if we look at the e-commerce sector, what we're seeing is uh, uh, somewhat expected, but I think this has now gone further than what people thought. After the initial stages of the pandemic, we saw retail, e-commerce retail sales just explode higher. You had everybody, of course, forced to stay home. The economy was shut for a month. Everybody's ordering their goods online. They're working from home, uh, going to school from home, everything else. So this led to an explosion in retail sales for e-commerce. And now we're seeing kind of a reversion to the mean and then some. So if you adjust for inflation over the past year, you're seeing a negative 2% real increase or now decrease in e-commerce retail sales. We haven't seen a negative number in that reading since the 08-09 recession. So just another one of many indicators that are pointing to a downturn in the economy. So something, of course, to watch. And it's no surprise to see the reaction to technology stocks this year when you see statistics like this. You had that boom here in 2020 and 2021, and prices got ahead of that. Multiples got ahead of that, and they were assuming that these growth rates were going to stay very high for a long period of time. And now that we're seeing the mean reversion, we're seeing the mean reversion in terms of stock prices as well. Let's talk about cycles in markets. This is a very important thing for investors to understand because when you have a diversified portfolio, there's going to be things that outperform and underperform, and that outperformance or underperformance can last for long periods of time, and it's hard to appreciate that when you're living in the moment. So one example here I think is an important one to look at is the cycles between emerging market stocks and US stocks. So, as you can see here, from 88 to 1994, emerging market stocks really exploded to the upside, outperforming. Then the US had a huge period of outperformance during the dot-com bubble period from 95 to 98. Emerging markets took control again after that. After the bust in the dot-com bubble, EM outperformed until 2010. And then since then, the US has been outperforming. And now, if we look at a ratio of emerging markets to US stocks, it's at its lowest level since 2001. And just to give you an idea how huge the differential in performance has been since October 2010, US stocks have more than quadrupled over that period of time versus only a 28% gain for emerging market stocks. So, very long cycles to everything. We're now in over a decade of underperformance of not just emerging market stocks. If I showed you international developed stocks, it would look very similar to this. Over a decade of underperformance for stocks outside of the US, which makes it very difficult to maintain those positions in your portfolio because you feel like you probably felt back in 99, 2000, thinking that the US was going to outperform forever. But over long periods of times, 20, 30 years, these things move in cycles. And so likely, we don't know when, at some point, there will be a reversion to the mean here, which is this blue line, and US stocks will start to underperform as well again. And so when will that happen? Nobody knows, but that's why you have a diversified portfolio, because if you have everything in one particular country, that could be problematic when you're in that period of decline. And you want to spread things out because you don't know when the cycle is going to shift or how long it's going to last. So this is, I think, an important concept, and Jeremy Grantham called profit margins probably the most mean reverting series in finance. And he once said that if profit margins don't mean revert, then something's gone badly wrong with capitalism. And so here's a chart of S&P 500 profit margins. We hit an all-time high in terms of profit margins, 13.5% last year, and now we're seeing a mean reversion here. It's moved down to 10.9%. The historical average going back to 2000 is about 8.5%. Now, what did Grantham mean by if they don't mean revert, then something's gone badly wrong with capitalism? You could say that's an extreme statement, but there's some truth to that, because in a capitalist economy, if you have competition and there's these excessive profits to be had, you would expect new firms to come in and to compete with those existing companies. And that competition would lead to inevitably better prices for consumers and lower eventually profit margins. And it also has to do with a balance between labor and companies. And sometimes companies have the upper hand, and other times labor has the upper hand in terms of what percentage of the profits go to labor. And in recent years, more of that has gone to corporate profits than to labor, and now we may be shifting gears in the opposite directions. But getting back to profit margins today, why are they going down? What we're seeing is a slowdown in terms of sales. So top line is slowing down. At the same time, you have just increasing pressures in terms of the cost side. So the combination of those two factors is leading companies to have lower net profits, right, after subtracting out those higher costs. And if you look and listen to companies like Walmart and Target, what they keep emphasizing is a twofold explanation. One is there's a shift of behavior in terms of consumers, where they're buying more staple items than discretionary items, and those items have embedded in them lower profit margins. And two, they are reluctant, Walmart and Target and these lower priced retailers, to continue to pass on these high rates of inflation, and therefore they're taking it to their bottom line in order to not to alienate these customers. So these factors are very important. That's one of the reasons why earnings have come down this year. You just have a lower level of profit margins. And if this were to continue, I think it would be an additional weight and headwind for the market. And so let's talk about streaming here. I thought this was a fascinating fact because I thought this would have actually happened years ago. I didn't know that it hadn't happened yet. There was an article in the Wall Street Journal saying that the U.S. viewership of streaming services, so Netflix and Hulu and all the rest of them, in the month of July, viewers actually watched more streaming than they did cable or broadcast, and that was the first month that that's ever happened. So the transition really just increased, obviously, during the pandemic. It's hard to believe. I think most people probably watching this would be hard to believe because you probably watch more streaming than cable. But according to Nielsen, now it's official. That transition has been made, and I don't think at this point that we're going back in the other direction. There seems to be, of course, a much higher demand every single month for on-demand content, and it's hard for people to go back to that old model. And every major cable operator is kind of getting on board with their own streaming services, recognizing that change in trend. So I want to end here with positive news, as I like to do, with things moving in the right direction. And number one, let's talk about the deficit, which for the first time since 2019 is below actually $1 trillion. So good news to see that reverse course. Again, this is going to help inflation the more it continues to fall. So hopefully that new bill doesn't add to the deficit. Hopefully it does, as they're saying, reduce the deficit somewhat. That remains to be seen. Again, in the early years, they said that it will likely increase the deficit and then go in the other direction. But regardless, this is a positive trend long term, right? It's been painful in the short run because you have less government spending, and that's going to hit growth. So the opposite effect that we saw in 2021. But in the long run, this is going to be good because it's going to, if we continue to do this, lower that rate of inflation. And so on that theme, let's take a look here at gas prices, which are now down to $3.90. So back below that $4 threshold. It's down around 22% from that peak here in mid June. So lowest levels in over 5 months. So you got to go back to March to find these levels. And so that's good news, obviously, for the American consumer and anyone who drives to work or has driven this summer in the past month or so for vacation. Certainly a welcome sign to see gas prices moving in that direction. And lastly, here I want to talk about the freight index. So the supply side is very important as well. We talked about demand in terms of demand coming down and that being a factor likely in driving inflation rate lower last month. But here's an important factor as well, which is the global container rate. So the rates that it costs for these shipping containers globally, and that's come down now almost 50% from its peak. Pretty steady decline here, lowest levels we've seen in some time. Importantly, it's still 4x higher than pre-pandemic levels, but this is something that is a huge positive if it can continue. I don't see any reason why it shouldn't. Hopefully, it'll keep continuing in this direction, and so we'll take all of these wins and hopefully they continue throughout the rest of the year. This would really alleviate the supply side of that inflation concern. There just was too much demand outpacing the existing supply, and all of the COVID shutdowns and impacts of that globally just built up to a situation that led to this just parabolic increase in terms of shipping costs. So a good sign, again, moving in the right direction. And so let's end there on a positive note. So thanks everyone for joining me today. Have a great rest of your week, and we'll see you next week. Thank you.